Hello, good day everyone. I am Nick and I am one of the account executive in Lemon Cafe, and today we're going to discuss about profitability ratios. Without further ado, let's start our discussion. Profit margins are financial ratios used to assess the profitability of a company by dividing the amount of net income by the revenue. They are expressed as a percentage and measure how much profit a company generates for each dollar of revenue. It is important because profitability ratios indicates a company's financial performance because they show how well a company is able to generate profit from its revenue. They are useful for comparing a company's profitability to other companies in the same industry or to the company's own performance over time. So moving forward, there are three types of profitability ratios, mainly gross profit margin or GPM, operating profit margin or OPM, and last one is net profit margin or NPM. So first one is gross profit margin. The gross profit margin or GPM is calculated by dividing the gross profit, which is revenue minus the cost of goods sold, by revenue. It measures the percentage of each dollar of revenue that a company retains as profit after subtracting the cost of producing the goods or services it sells. So to interpret the GPM, a high GPM may indicate that the company is efficient at controlling the cost of production and is able to sell its products or services at a higher markup. But a low GPM margin or GPM may indicate that the company is struggling to control its production cost or is unable to sell its products or services at a high markup. Next is the operating profit margin. So the OPM is calculated by dividing the operating profit, which is the gross profit minus operating expenses, by its revenue. It measures the percentage of each dollar of revenue that the company retains as profit after subtracting the cost of running the business, such as salaries and rent. So to interpret the OPM, a high OPM may indicate that the company is efficient at controlling its operating expenses and is able to generate a lot of profit from its revenue. But a low OPM margin may indicate that the company is struggling to control its operating expenses or is unable to generate a lot of profit from its revenue. The last ratio that we're going to discuss is the net profit margin. The NPM is calculated by dividing the net profit or the total profit after accounting all the revenue, cost, and expenses divided by its revenue. It is measure the percentage of each dollar of a revenue that the company retains as profit after accounting for all costs and expenses. To interpret NPM, Uh, a high NPM margin may indicate that the company is efficient at controlling its cost and expenses and is able to generate a lot of profit from its revenue, while a low NPM may indicate that the company is struggling to control its cost and expenses or is unable to generate a lot of profit from its revenue. So again, that is GPM, gross profit margin, OPM, operating profit margin, and net profit margin or NPM. In conclusion, profitability ratios are important indicators of a company's financial performance because they show how well a company is able to generate profits from its revenue. Gross profit margin, operating profit margin, and net profit margin are all useful ratios for evaluating a company's profitability. Moreover, it is important to consider the context and compare the ratios to industry benchmarks or the company's own performance over time. However, profitability ratios should not be used in isolation, as they do not give a complete picture of a company's financial health. It is important to consider a variety of financial metrics and perform a holistic analysis of a company's financial health. Again, this is the profitability ratio. That concludes our presentation again. My name is Nick, one of the account executive in Pearl Lemon Cafe. See you on the next videos. Thank you and goodbye.